What would it realistically take to turn a $1,000 investment into $5,000 by the end of 2026? It sounds almost unreal, but in the world of high-growth equities, this kind of move is known as a 5x return, a 400% gain. Now let's be clear from the start. This is a thought experiment, not a promise. Broad market indexes like the S&P 500 historically deliver far lower annual returns. But when certain sectors undergo major technological or economic shifts, individual stocks can move very differently. That said, aiming for aggressive growth always comes with aggressive risk. To even have a chance at returns like this, a company usually needs to be solving a massive problem or entering a true hypergrowth phase of its business cycle. Today, we're looking at 10 companies that market data and analyst coverage suggest have confirmed time-specific catalysts scheduled for 2026. We'll look at the numbers, the sectors, and most importantly, the risks. This is an educational breakdown only, not financial advice. Let's dive into the data. We begin with the infrastructure backbone of the artificial intelligence revolution, NVIDIA. By early 2026, NVIDIA is not simply relying on existing demand. Data shows the company is scheduled to begin shipments of its H200 AI chip to select markets as early as mid-February. At the same time, NVIDIA is moving towards specifications for its next-generation Rubin GPU architecture. As of the latest reports, the company is posting year-over-year revenue growth of more than 65%. The risk here is valuation and expectation pressure. With a market capitalization already exceeding $4 trillion, sustaining this pace requires near-perfect execution in a supply chain that is often constrained. Next, we move into the space sector with Rocket Lab. While the company is best known for its small Electron rocket, 2026 represents a potential shift in its business model. Rocket Lab is scheduled to conduct proving flights for its much larger Neutron rocket in the first half of 2026. This would place the company into the medium-lift launch category, which commands significantly higher revenue per launch than small satellite missions. Quarterly revenue growth has been reported around 48%. However, this is a high-risk investment. Rocket Lab is not yet profitable, and the aerospace industry is unforgiving. A single failed launch can materially impact investor sentiment. Moving into Southeast Asia's digital economy, we have Sea Limited. Often described as the Amazon of Southeast Asia, Sea operates 3 core businesses: Shopee for e-commerce, Garena for gaming, and SeaMoney for fintech services. Revenue growth is currently tracking around 30% year over year. The key catalyst heading into 2026 is the expansion of SeaMoney, particularly merchant lending and digital financial services designed to support small businesses. The primary risk here is regional exposure. Sea is highly sensitive to consumer spending conditions in Asian markets and faces increasing competition from rivals such as TikTok Shop and Lazada. Number 4 is the Trade Desk. The company operates a demand-side platform that allows advertisers to buy digital ad inventory outside of large social media ecosystems. Growth is being driven by the shift toward connected TV advertising as streaming platforms continue to capture audience share. For 2026, the Trade Desk is integrating deeper AI-driven bidding systems designed to optimize ad performance. Revenue growth currently stands near 21% year over year. The risk is cyclicality. Advertising budgets tend to contract during economic slowdowns, which could impact revenue growth if global conditions weaken. 5th on the list is Shopify. Up to this point, every company we've discussed shares one common theme: high growth paired with high volatility. Now, let's move into the most aggressive segment of this list. Rather than operating a marketplace, Shopify provides the infrastructure that allows merchants to sell directly to consumers. The 2026 catalyst to watch is Shopify's expansion into enterprise-level merchants, alongside the continued scaling of its AI-driven marketing tools, including Shopify Audiences. Revenue growth remains strong at approximately 24% year over year. The risk is valuation sensitivity. Shopify often trades at a premium relative to earnings, meaning any slowdown in growth could result in sharp stock volatility. Number 6 is IREN Limited, formerly known as Aris Energy. The company operates energy-intensive data centers that serve both Bitcoin mining operations and AI cloud computing workloads. A critical milestone is scheduled for April 2026, when IREN plans to energize its Sweetwater substation. This expansion supports up to 140,000 GPUs. Revenue growth has recently exceeded 200% year over year. This is a high beta stock. Performance is closely tied to Bitcoin prices and regulatory developments surrounding energy usage. Next is Chinese electric vehicle manufacturer XPeng. Beyond traditional EV production, the standout catalyst for 2026 is the launch and flight operations of XPeng Dias Aero HT flying vehicle, part of China's emerging low-altitude economy. Vehicle delivery volumes have more than tripled year over year, However, the risks are substantial. The company is not yet profitable, and geopolitical tensions or trade restrictions could limit international expansion. Number 8 brings us into the commodities sector with Aris Mining. The company focuses on acquiring and operating gold assets across the Americas. Data screens indicate projected earnings growth approaching 75% heading into the 2026 fiscal cycle. As with all mining companies, performance is heavily influenced by gold prices. A decline in gold could compress margins quickly, and operational risks remain inherent to the industry. Number 9 is MicroStrategy. While technically a software company, MicroStrategy has effectively transformed into an institutional proxy for Bitcoin exposure. The company continues to pursue an aggressive Bitcoin treasury strategy through 2026, often using leverage to increase holdings. This results in amplified price movement, both upward and downward. If digital asset prices decline, MicroStrategy's valuation and debt exposure could face significant pressure. Finally, we have Qualcomm. Traditionally known for mobile chips, Qualcomm is actively diversifying beyond smartphones. The 2026 catalyst is the commercial rollout of its AI-focused data center chips, aimed at offering more cost-efficient AI processing alternatives. The risk remains smartphone market saturation and intense competition from established data center chip providers. From artificial intelligence infrastructure and space launches to flying vehicles, digital finance, and gold production, these 10 companies all have clearly defined milestones tied to 2026. But high growth potential always comes with high volatility. Market conditions, interest rates, and geopolitical events can change the trajectory of any stock overnight. This is why professional investors emphasize diversification rather than concentration. Which sector do you believe has the strongest potential heading into 2026? AI, space, or commodities? Let me know in the comments. If you found this data-driven breakdown useful, consider liking the video and subscribing for more research-focused market analysis. Thanks for watching.